Before we start this video, do like and subscribe to our channel and not miss on any updates.
Yeah, so you might remember in level one, we dealt with the basics like understanding income statement, understanding balance sheet, cash flow statement, then the various techniques, okay, then modeling, a bit of modeling, quality, finance statement, qualities, etc. So when it comes to this level two, we'll touch certain topics such as pensions and intercorporate investments, multinationals, which are somewhat linked to income statement, balance sheet, and cash flow statements in one way or the other. But this requires certain special treatments. So it's not like a regular expense or activity that a company does. Okay. If a company only buys and sells goods or services, provides services, and it operates locally, okay, and it's relatively a new age company, these three things generally doesn't arise except for the share compensation. So intercorporate investments, it's not part of a general normal activity of a company. It's only when a company wants to take stake in a company, other company, that it arises. Similarly, if a company operates in only its domestic market, then generally this multinational operations doesn't arise. Okay, this is kind of a uh, advanced topics where a company does a lot of things. It operates in various countries. Okay, then only these kind of things arise. Then we are going to jump into the analysis of financial statement institutions. Okay, till now, whatever the concepts we have learned, the financial analysis techniques in level one, like ratio analysis, okay, the ROIC ratio, ROE ratio, those are kind of looked at from a non-finance institution perspective, like manufacturing company or a service company. But when it comes to a financial institution, what is a financial institution? It could be a bank, it could be an insurance company, it could be a mutual fund, a venture capital. Okay, for those companies, the way we do analysis will be very different because there it is directly we'll be directly dealing with money. It's like exchange of money that is involved there. But in case of other companies, non-financial institutions, either goods or services is exchanged for money. So the way the business is done there and in a financial institution is different. There we have like various frameworks like Camel framework. Okay, the regulation is also very higher compared to non-financial institutions on the financial institutions because banks and insurance companies, they play a very crucial role in an economy, and they directly deal with money, so they have a lot of regulations on them. Then like once we deal with the first three topics, okay, the advanced topics and financial institutions, then we go into the consolidation phase. Consolidation means consolidating our knowledge. So whatever we have learned in level one in terms of basics and the advanced concepts that we learned in the first three chapters, we are going to include everything in this integration phase. Okay, first we are going to see what is the quality of financial reporting, because there are various kinds of investing strategies that any company or an individual can pursue. Okay, they can go for an technical analysis, someone can go for a fundamental analysis, someone can go for a macro investing perspective, like looking at a from a country perspective to invest rather than individual companies. But in this specific matter, we are going to deal with fundamental analysis. Whenever we are talking about fundamental analysis, the financial statements becomes very important, and because of that, the quality of the financial statements becomes the utmost important. Okay, so let's say you do the financial analysis, you base your data entirely on the data that the company gives. But if the data that the company gives is not of good quality or is not sufficient, then the whatever the analysis that is being made, that won't be of much use. So we as an analyst, like we have to first ascertain what is the quality of the financial state reports that are being provided to us. So one way of doing it is looking at the audit report. Okay, those is one level. Like looking at audit reports, there is some level of assurance we'll get. Then we need to also look at the way the company adopts various accounting policies. Okay, whether it is sustainable or not. Okay, whether they are adopting reasonable policies, not too aggressive or not too cautious. So we have to assess these things in this chapter, like in the quality of financial reporting, we look at these things. Then the integration phase, we do a holistic approach. Like from beginning to ending, what a company, how the company generates revenue, where does it get the profitability from, what are the various returns it gets, how are it peers like peers doing compared to this company, then what is the valuation of this company and how it is it faring versus its peers. So in this integration phase we are going to combine all the knowledge that we have into this. Okay, then I think the CFA syllabus is also structured in such a way that after this we have that corporate issuers and equity valuation. This nicely sits into that. The final part is modeling. Like ultimately it boils down to whatever the knowledge that we are acquiring, we need to create a model. So first thing, a model is nothing but it's a map. So let us understand, like if for example there is Hyderabad. Hyderabad is a geographical location. Okay, to understand Hyderabad there is a map. Okay, map is not actually Hyderabad, but it is kind of a representation of what is Hyderabad. So it is a kind of a simplification of what is there in Hyderabad, a map. So in a way, if you if you similarly compare it with a company, a company has a physical existence. It might have a head office, or it might have various manufacturing facilities. It has a distribution, retail, everything. So as an analyst, for us to analyze it, we need to create a model for it, which is like a map we have for a city or a state. So once we have a model, we can create a lot of forecasts. Okay, we can analyze the past history of that company. Okay, we can forecast what might happen in the future. Okay, so it gives us a lot of flexibility, but we always need to remember that the map is not the territory. Similarly, the model is not the company. Okay, so we should always be very careful when we create a model. So we already have another. I think we in the level one there is a modeling topic that they have introduced. So here also in level two also we are going to discuss how to forecast various items and those kind of stuff. Okay, so that's the overall topics that are there in level two. Any questions? You know? So the first topic that we are going to deal with is intercorporate investments. Okay. So intercorporate investments, this generally arise when a company invests or purchases debt securities in the market. Okay. So let's say a company has it is doing its normal operations. Okay, it has generated excess cash. Okay, either it can invest that cash in its own business as a capex to build new plants or like invest in some research and development expenditure or something, or give can it can give it back to shareholders through either dividends or share repurchase. But in certain situations a company can find it more advantageous to invest that money in another company. Okay, either it can take 5% stake, 10% stake, 20, 50, or can take by 100% of the company, it doesn't matter. But a company might find it beneficial for its operation to buy stake in another company. Okay, that is when this thing comes, like the intercorporate investments. So in level one, if we looked at the balance sheet of a company, here I have for illustrative purpose, I have put the balance sheet of Tata Motors. So, if you look at the non-current asset side of the balance sheet, there is property, plant, and equipment. This was dealt in the level one in terms of the long-lived assets. There is capital work in progress, right of use assets. Then there is goodwill. Goodwill, we had some definitions in level one, but we didn't go in deep into it. Okay, then there's other intangibles. It was already covered in level one. So there are a lot of things like financial asset was briefly covered, then deferred tax asset. Yes, these things were covered, but the goodwill and investment in equity accounted investees, that was not covered in level one. So these are the topics that are dealt, like how goodwill is created, how goodwill is accounted for in the future years, how it is impaired, etc., and how investments in equity accounted investees is accounted for. Those things are going to be dealt in this current topic. It is important because certain companies, they want to grow not by investing organically, like in new plants, in new in new factories, or expanding their services, they might acquire another company to expand. So let's say a company has two options to grow. If a company is based out of in India and they want to expand it into, for example, US, okay, they might directly go there, incorporate their own company, and create assets there to serve the customers, or they can buy a company which is already doing that, and they can take up stake in that, they can own that company. So these two ways a company can grow or expand into multiple businesses or other geographies. So if a company follows the second way of doing it, like acquiring an already existing business in another country, then there will be certain intercorporate investments, and then their goodwill will arise. Then like associate companies will arise, financial assets will arise. So these kind of things will come. So let's go deep into the topic. So okay, so how, like for example, a company has bought around 20% of stake in another company. Company A bought 20% stake in company B. That is the situation one. Second situation, a company bought around uh, more than 50% of another company. Okay. And third situation, a company bought less than 20%. It's not like, okay, like 5-10% stake they have bought. How are you going to account for this in these three situations? Okay. So the key thing here is, so the first thing, how much of influence that the company A has on company B? Okay, the acquiring company has on the acquiring company. If the company has no influence in terms of the decision making of company B, okay, it is just acquired it as a financial investment. Okay, I will acquire 5% of another company. Okay, I will keep it. I will collect my dividends. In future, if I get good capital gains, I will sell it. If that's the approach, and they have no interest in influencing the company, or like doing some business with the company, that's fine. Like they buy 5% or 10% of the company, and they remain as a passive investor. That is one approach. So then it is accounted for as a financial investment. Okay. But okay, let's say a company acquires some 20-25% stake in another company, more than 20 basically. It's generally a, like a what you call some kind of a benchmark. It's not like written in a statute, but it is basically about 20%. The company will have good influence on another company in general. So, I mean, a classic example of this could be um, like Bharti Airtel. Bharti Airtel, which is a telecom company, owns around 42% stake in Bharti Infratel. Okay, and Bharti Infratel provides this tower business to, like, it leases out towers to various telecom companies. Like basically, Bharti Infratel merged into Indus Towers. So right now it is Indus Towers. So Bharti Airtel owns around 42% in Indus Towers. Similarly, Vodafone owns certain percentages in Indus Towers. While no particular telecom company fully controls the company like Indus Towers, they actually significantly influence the decisions of this Indus Towers. So why these companies usually take stake in another company to have significant influence is because they have business interest in them. Similarly, like a car manufacturer might purchase stake in a spare part manufacturer because they are very crucial for them to maintain that supply chain. Okay, so they might purchase some 20-25% stake to have a say in that company. Okay, for example, there is a supplier of doors for a car. Okay, and it's a major supplier to a car manufacturer. Okay, so if car manufacturer doesn't have any stake in that spare part supplier, in future, let's say a competitive car manufacturer, if they purchase the entire spare part manufacturer, then this company's supply chain will be disrupted. Okay, so that's why, to just maintain a significant influence or to control its technology, these companies generally have certain stake. That is when they will have significant influence, and it is accounted for as an associate. Okay, the third case is having outrightly buying the company, either by buying more than 50% stake. Whenever there is a 50%, usually more stake is owned by one company or another, they can actually control that company. Here the control is denoted by whether they are able to like decide the board of directors, like all the major operating and financial decisions are being handled by the parent company. Okay, the one which invests the money into the like the subsidiary or the other company which where it has acquired more than 50%. So this is in this case situation we follow an acquisition method where we consolidate the financial statements. Okay. So apart from all these three cases, there's something called joint venture, where a couple of companies might they which are into similar industries or in different industries might want to pursue a particular project or a particular business while collaborating their funds. In this case, joint venture is formed where not like no one party entirely controls the company. It is shared by both companies. So in joint ventures also, the equity method of accounting is usually used. Right? Uh, yeah. So this is on classification. So whenever there is an intercorporate investment, the first thing you have to think about is what is the level of influence that they have, whether it's level of control, like whether it is going up to the controlling the company, or it's just a significant influence or no influence. It's a passive investment, then we need to just treat it as a financial asset. If it's a significant influence, it will be an associate. When it is like more goes in more into a control situation, then it is treated as a subsidiary. Okay. We'll do a quick module quiz on this particular topic. So the first question, Jeremy, can you go through the first question?
Toll Company owns 30% of the common equity of Short Incorporated. Toll has been unsuccessful in its attempts to obtain representation on Short's board of directors. For financial reporting purposes, Toll's ownership interest is most likely considered
A. Investment in financial assets. B. Investments in associates. And C. Business combinations. Okay, so let's understand the question. The Toll company basically acquired 30% in Short Incorporated. And even though having it has 30% financial interest, Toll has been unsuccessful in its attempt to obtain representation on Short's board of directors. Okay, so generally one company acquires stake in another company either to influence like to get board of directors. For example, there are 10 board of directors. Depending on the stake it owns, the acquirer might ask, okay, give us 2 board seats or 3 board seats so that they have a say in the policy making of the acquiring company. Okay, so in this case, like Toll has been unsuccessful in attempting to get a board of directors. It's actually not very common. Like owning 30% and not getting any board representation is not very common. So this is kind of a unique case where they have 30% but no influence on the company. So as we discussed, like uh, it needs to be treated as associate when there is significant influence. When they have full control, they it is treated as like they combine the businesses in an with using acquisition method. And in this case, they don't have any say for the company because they didn't get any board of directors. So what is the most probable answer here? Like any guess, any guesses? Any guesses? You can type it in the group chat. Yeah. So Garima has replied A. That's the right answer. Because yes, like you might get confused that here the company owns 30%. Then why you already said like if a company owns 20 more than 20% of the stake, it should be treated as a associate. Then why here you're saying it's investment financial asset? Because it's not about owning how much percentage. The company can own like 40% in another company, but still has no say in it in the other company. It can remain a passive investor. So in that case, it is treated as a financial asset. It is treated as an associate only when it has significant influence. Okay, significant influence occurs when one company is able to like influence the operations or financing decisions of another company. So here in this specific case, they haven't told anywhere like all companies able to influence Short Incorporate. So this option B is eliminated. Option C, business combination, only comes in a situation where the company, tall company controls short company. So with 30%, tall company cannot control short incorporated. So business combination option itself won't appear. So option A will be the right answer. Okay. So any doubts on why on this thing? Like I think couple of you guys have told like either option B or C. I hope it is clarified now. Now, so of the three classifications, to check influence, we need to just see the representative. That yeah, that we will come. So on the representation part, so just to clarify, so not just board representation, there are like 4 or 5 factors that we have to look at. One is board representation for sure. The second one is how much technology back and forth is going on. So let's say the company has only 10%, has 20% stake. It doesn't have any board representation, but the company is like the associate company, whatever the company in which 20% or something is invested, that company is heavily dependent on this parent company for technology. Okay, then it becomes a then it can be perceived as a significant influence. So there is no like a hard line where we can draw. So that is a one possible situation. The third situation is there are significant intercompany transactions. So the example that I given where a car manufacturer invests in a spare part manufacturer, there is huge intercompany transactions. In that case also it can be perceived as a significant influence because majority of the sales are dependent on parent company. The other situation is like there is a regular exchange of executives between the companies. Let's say the CEO of company parent company, he also participates like regularly in the decision making of the subsidiary, or the COO participates in this. So when there is exchange of executives also, we can perceive it as a significant influence. We will come to that in the third module. Okay, so we will have a detailed discussion on that again. Here the financial assets, so where the company passively invests in another company, there is no like active investment, actively influencing the subsidiary. So in this case, there are a couple of methods to classify investments. The first one is amortized method. So this is dealt in IFRS 9. So amortized method is only used for debt securities, like equity securities. Amortization concept itself doesn't arise. So you can think that amortized cost only for debt securities, while the other two, there is fair value through then there is fair value through P&L, and there is fair value through OCI, which is applicable to both debt and equity securities. Okay, so amortized cost, generally like to apply amortized cost on a particular debt securities, it has to satisfy two conditions. So one is business model test. So what is a business model test? So let's say company A is there. It has bought Indian government securities. Okay. So Indian government securities, and it has only bought those securities because it had some excess cash in its books. Okay. So it has bought the security. It has kept it with them, and every year they collect cash. Okay, as in the form of interest, and by the maturity of these bonds, they just collect the maturity amount. If that is a thing, then it's a business model test is passed. So you only hold the security for like the interest and the maturity amount. There is no convertible portion. Okay, these kind of things are not there. So that is one condition. Second thing is cash flow characteristics test. That is, the security that is being held only pays out either interest and maturity principal amount. That's it. No other payments are being made. So that is the second condition, cash flow characteristic test. If these two conditions are satisfied, then a company can apply amortized cost method to debt securities. Uh, that's what the conditions are. So here you can read, business model must be to collect contractual cash flows. The contractual cash flows are usually the interest and the principal amount. And like the accounting treatment is same as held to maturity, which means the wording is different. So under US GAAP, it is called held to maturity, the same amortized cost method. So the accounting treatment is more or less the same. So in the amortized cost method, whenever a company buys bonds, debt securities if of another company, those are generally recorded at the cost. So they are carried at the balance sheet at the amortized cost. So initial first year they are acquired, they are recognized at the acquisition cost that has been made. Then every year amortization cost is recognized. Okay. The change in market value is not recognized unless it is impaired. So every year the change, if that particular security is being traded in the market, we don't recognize the change in market value. It is just recognized at the acquisition cost, and every year amortization is being done. We are going to discuss about the amortization concept, like an example at the end of the session. We like at the end of the these slides, we have a case of explaining of how these amortized costs work. So as of now, just remember the concept that to use amortized cost for a debt security, we need to first perform two tests. One is business model test, the other one is cash flow characteristic test. So if the business model, both conditions are met, then we can use debt securities. Then we can use amortized cost method on debt securities. But this particular amortized cost method is not used for equities. Okay, right. And yeah, so the second way of recognizing the financial assets is fair value through profit and loss account. So this is like the name itself is quite evident, where you recognize you at the date of acquisitions. Obviously, you are going to recognize it at acquisition price. Then at the end of every financial year or every reporting period, we are going to recognize it at fair value. And whatever the difference between your cost and fair value, that passes through P&L. Like the name itself is pretty evident. It can be applied on both debt and equity securities. So, for example, a debt security which doesn't pass these two tests, like the business model and cash flow characteristics test, which has some convertible portions in it or some other condition, that is usually like then the company has an option to either choose for fair value through profit and loss account for these things. Uh, so, like in this method, generally in P&L, interest income, the dividend income, any realized and unrealized gain or loss is reported on the income statement because it's fair value through P&L. Whatever the incomes and gains are recorded in the profit and loss account. Similarly, the interest component is equal to the coupon component plus amortization discount minus amortization premium. This is also we are going to discuss with an example so that you will understand better. Carried on the balance sheet at fair value. Yeah, it's fair value. The method itself is fair value through P&L. It is recognized at whatever at the end of every reporting period. It is revalued, and that whatever the value is being recognized in the balance sheet. Then OCI is very similar to fair value through P&L, but the whatever the profits or unrealized or realized gains are recognized not in the profit and loss account, but other comprehensive income. So as you might remember in level 1, we learned that while there is income statement, there is OCI through which certain items pass through, like the unrealized these things, and there are certain pension related adjustments that go through OCI. Okay, or any foreign exchange losses or gains, some items go through OCI, other comprehensive income, which directly feeds into the equity. So similarly, like debt and equity securities can opt for fair value through OCI. The interest and dividend income are reported on the income statement. Then the interest is nothing but the coupon, same as the fair value through P&L. It is carried at the balance sheet at fair value. Similarly, only the gains or losses are directly reported through OCI into the equity. So that's the major difference here. So rest all is the same. Only the fair value changes are recognized directly into the equity through OCI. Yeah. So Then a question might arise like, what if once we have decided whether to use FVTPL or amortized cost method, what like in future the characteristics might change, the company might change its mind. What is the like what will happen if we think that we need to change the classification? No, like it's generally it's not possible. For equity securities, once the initial choice is made between fair value through P&L or fair value through OCI, it's not possible to change. It's irrevocable decision. But just in case of debt securities, when you are using amortized cost method, and subsequently the situation has changed. Like what are the two tests that we are doing, right? The business model test and the cash flow test. The business model test is changed. That means like the new conditions have been introduced for the debt security or something like that. Then only it is allowed to be changed into FVTP. Okay, so that's the only condition. But in general, it is irrevocable. This could be a potential testing topic in the CFA level 2. They will ask like, okay, under what situation we can change the method of accounting for debt securities, like of the one which is most accurate. Then they will give three conditions, and they might put that okay, there is change in business model. So that kind of situation, this can be tested a lot. So just remember this situation, like for only for debt securities they allowed. For equity securities there's no change. Like you have to either choose it once and you have to follow that for the rest of the time. Okay, so yeah, whenever there is a reclassification, whatever the unrecognized, so once it is being accounted for as an amortized cost method, then in future uh, when they change it to FEPL, fair value through P&L, they need to recognize the whatever the unrecognized losses. So they, let's say they have bought it for 900 rupees, and later they change the method and current fair value is 1100 or something. Then the 200 million is recognized as unrealized profits. Okay, in the P&L account. Similarly, like once when it is being transferred from FEPL to again amortized cost, then also like it is generally transferred at fair value. Okay, the fair value is generally taken into the amortized cost method, right? So that's the thing. These all slides and all you can download it from the Kaplan website. So if you want to revise it or revisit it, you can go to the Kaplan website. I will show you like how to access them as well, so that in case you want to have a look, you can go through. So it's kind of a provides a summary of whatever we have discussed till now. So security classification, FEPL, FETOC, OCI, amortized cost, the balance sheet. It's pretty self-explanatory. Fair value for both these methods, FETPL or FETOCI, and for amortized cost, it's amortized cost method. Then in income statement, we generally recognize dividend, interest, realized um, gains and losses, unrealized gains and losses. Similarly, for OCI, in income statement, we recognized dividends in interest. Here we don't have recognized uh, gains and losses and unrecognized unrealized gains and losses, because that goes into other comprehensive income. It's not actually recorded in the P&L, but rather in the other comprehensive income and directly feeds into equity. In amortized cost method, the option itself doesn't arise. The revaluation of assets or fair value itself doesn't arise. So it's only interest realized gains and losses. That's it. Any questions till now? We will next jump into the example like that I was saying. So yeah, like for debt instrument, it's coupon and amortization. At balance sheet, it's measured at amortized cost. For F, like it's pretty self-explanatory. So that when we jump into the example, we will get better idea. Like, yeah. Any questions till now, with you guys? So let's jump into this example. The question is, at the beginning of the year, Midland Corporation purchased 5-year bond, 5-year 9% annual coupon bond with a face value of 1 lakh for 96,209. The key thing to note here is the fair value is 1 lakh while it is acquired for 96,209, which means it is being acquired at a discount. Okay, just keep that in mind. Because it is acquired for a discount, the yield is not matching with the coupon rate. It's usually higher because it's like 1 lakh into 9%, you get 9,000. Okay, 9,000 divided by 96209 over 5 years is generally the present value is calculated. So the YTM, year to mature, yield to maturity, will be around 10%. Okay, it was bought at the beginning of the year. By the end of the year, the fair value of the bond at year end is around 98,500. Okay, that's an important factor to remember. So here the question is, determine the balance sheet income statement effects if the bond is classified as amortized cost. So they are asking, if a bond, what will be the balance sheet and income statement effects under three classifications that we have discussed so far: the amortized cost, fair value through P&L, and fair value to OCA. Okay, so let's start with the amortized cost. So on the balance sheet at the end of year one, uh, amortized cost method. So it is anyways, it's not the fair value is not recognized. So even though it is, they are saying like 98,500 is a fair value, it's nowhere it's recorded. It's we record around 96,830. And how did we derive at 96,830 is 96,209 plus the amortized discount. Okay, so initially I noted that the bond was acquired at a discount at 96,209, while 1 lakh is the face value. Okay, so the difference between the two, basically the 96,209 and 1 lakh, that is actually amortized over the 5 years. So 1 lakh minus 96,209 divided by 5 years. Okay, so what happens is, so let's say this company in the year one they have acquired for 96,209, right? So they use 96,209 into 0.1, that is 10%. So the interest amount comes to around 9621, right? So the 9621 is the interest income that is being recorded in the income statement, while the cash that they receive is will be 1 lakh into 9%, because generally the interest amount is calculated based on the face value and the coupon rate. So the interest that will be paid will be 9,000. If we minus 9,000, we get the annual amortization that we are going to charge, that we are going to add to the bond value in the balance sheet. So 621 is there, right? So that 621, this 621 is added to the initial acquisition cost. So 96,209. So I will do it again. So there is 96,209, okay, into 10%, we get 9621, 9,621. 9,621 is the interest income that is recognized. But the cash that the company will get is 1 lakh into 9%, that is 9,000. So the difference between the two, that is minus 9,000, if we do, it is 621, is because the company was able to acquire the bonds for a discount. This is the amortization cost that they have to add in the liability in the bond value. So that's what they are doing. So they add 96,209 plus 621. Then this will be the year end end of year one book value. The interest income will be 9621. Okay. So this is how the amortized cost is accounted for. Then in the end of year one, if it is fair value through P&L, in the fair value through P&L, at the end of year one, the fair value is okay. You have it here, 98,500. They already given it, so directly it goes into the balance sheet. And for the interest income, as discussed, 9621. But for the calculation of unrealized gain, so what we have to do is we have to take the initial recognized value, that is 96,209, that is what they have acquired for, plus 96,209 plus they have to add that 621 component, okay, to arrive at this basically. So 998,500 minus 96830, we get 1,670 as the cumulative unrealized gain. Okay, this is the gain that is being calculated during the period, right? So basically we took the uh, 98500 here. If you see, this is the fair value at the end of year one. Okay, minus 96830. How did we get 96830? We got it by adding 96209 plus 621 of amortization, right? So every year we are going to add this amortization. With this amortization amount again is you like we have already checked it comes from the difference between the 10% of the amortized cost minus the actual interest that is being paid, right? So this is the situation for fair value through P&L. Any doubts so far? Like it's a bit confusing, but if you guys have any doubt, you can just the for OCI or fair value through OCI is also somewhat similar. The only thing is the whatever the unrealized gain or loss that goes through OCI rather than P&L. Like it doesn't appear in income statement. But as such, the interest income is recognized, which is like 96, the acquired price into the acquisition price into 10%. The whatever the fair value that is there at the end of the period, that is recognized. While the difference between the current fair value and the acquisition price plus amortization, that is actually recognized as the unrealized gain. So that is the thing on the that is how like the debt instruments are accounted for in three methods. Okay, as far as loan impairment is concerned, why loan has come here is like so debt securities in debt securities, loans are also considered as kind of a debt instrument. So when there is debt instrument, sometimes a company can give like intercorporate deposits or an amount as a loan to another company. So that way, like earlier in old model, they used to be like incurred loss only when the losses are incurred, it is recognized. But in the new model, under IFRS, any expected loss are also incurred. It's more forward looking. Basically, the standard has made it more forward looking, and any credit loss, anticipated credit loss, that are recognized in the income statement. So that's for the second topic. It's like we have like on a broader level we are looking into how financial assets are accounted for. So we'll take a short 5 minutes break and we'll come back to the next module. Welcome back. So as we till now discussed what are the various classification of financial assets. It could be for intercorporate investments, it could be financial assets, it could be associates, or it could be a full-blown combination. Okay, so first we have completed the financial assets where there are three kinds of classifications: the amortized cost method, then FVPL, fair value through P&L, and there is FVOCI, fair value through other comprehensive income. So there are like various nuances on what are recognized in the P&L, how the realized or unrealized gains or losses are recognized. For example, in the FEPL through the income statement, while in the FVOCI it is recognized through other comprehensive income. Okay, so now we are going to go into the second part of the discussion, the third aspect of the decision, that is the investment in associates. So as we already noted earlier that a company can account for an investment in another company as an associate only if it can prove that it has significant influence. If it cannot prove that it has significant influence, it will form part as a passive investment and you need to follow a financial assets method. So the methods we discussed earlier. So, but in this case, when a company like owns like more than, it is general rule, like if it is only owns more than 20% but less than 50, it is considered as an like an associate, but that's not the only criteria. Okay, in those cases, uh, it is it is accounted, it is called an associate, and it is accounted through a method called equity method. Okay, so is equity method we are going to discuss at length, but you can remember that equity method. So let's say you acquire the other company for around 100 crores, 100 crores. So you record that at the time of acquisition at 100 crores, and later the other company earns an like a net income of let's say some 10 crores. Okay, then what you will do is, whatever you recorded like the 100 crores for some 10% or 20%, let's take it as 20% for 100 crores. So you also attribute the income that the associate company is generating. Let's say it has earned 10 crores. So you take 20%, that is 2 crores, and add it to the initial cost that you have acquired it for. Then any dividend that you received, you reduce it. So essentially you are actually creating kind of an equity account for that associate company. That's why it is called equity method. So equity, how do you do in a balance sheet? In equity, it increases by the net income that you generate, then it is reduced by the dividends that you pay out. So net, it's the difference between the change in equity is nothing but the difference between the earnings that you make and the dividends that you pay out. So that's similarly you account for the investment associate by adding the earnings, your share of earnings minus your share of dividend. Okay, then you will get the closing balance. That's how the balance sheet work. But in case of income statement, you record only the income that you received. Okay, so only the net income. So the net income is 10 crores. Your share is 20%. That is 2 crores. You record it as share of income from associates in the income statement. Okay, the cash you get is through dividends. So in the cash flow statement, you get the dividend received from associate. So overall, if you look at the financial statement, income statement, it will be below. It will be the the income that is being generated by the associate company into 20%, whatever the 2 crores. Then in the balance sheet, it will be the acquisition price plus the associated income minus the dividend. You will get the closing balance, and in the cash flow statement, it is the dividend received. Okay, so that is being explained here. If we jump to the next slide, the point we were discussing earlier. What is the evidence of a significant influence? So one, it could be representation on board of directors. That is pretty evident. Then it's a participation in the policy making. So even though they might not have the representation in board, they might be consulted regularly. The parent company could be consulted regularly on various decisions that the associate company is taking. So in those cases also, it can be an evidence of significant influence. Sometimes lot of these things can present at the same time. It's not like if one is there and this is not be there. Multiple things can exist at the same time. Material transaction between the parties, as noted earlier, like let's say a car manufacturer holds stake in a spare manufacturing company, spare parts manufacturing company, and whatever the auxiliary industry, it has major business with the parent company, then it is kind of a heavily dependent on the parent company, and which gives it an influence over it. So that is also one key example. The interchange of key personnel like CEO, CFO keep on like changing for keep on coming from the parent company. Then it's also a kind of an evidence. Technological dependency already noted. Influence mainly on the financing aspects, on the operating aspects, amount and timing of dividend. If those are also kind of influenced by that other company, then we can say there is a significant influence. Don't worry, in the questions, they will like clearly give any of one of these things. So you will be able to read the question and get to know that okay, whether the material like the significant influence is there or not. We are going to solve few questions to get some idea on how this works. So yeah, here there is an example. Company P invests $100 in company S for 30% stake on December 31st, 2005, 2005. Earnings and dividend for the next 2 years are like it's 400 for 2006, 100 dividend, and for 2007 it is earnings to 600 and dividends is 150. So how do you account for this is okay. So let's do it. Opening an Excel sheet so that we can do the workings there. So here, like if we look at it, so basically the discussion we made, 1000 was the investment plus the earnings, their share of earnings, that is 400 into 30%. 400 into 30%, it is 120. 100 into 30%, 30. So basically what they are doing is 1000 plus 120 minus 30. Okay. So 1000 plus 120 minus 30 is 1090. Okay, but the income statement we discussed like only the share of earnings is only recognized. Okay, this dividend is generally recognized in the cash flow statement because that results into cash for the company. So in the year one, opening balance is the original investment made. Then share of earnings 120 is calculated as 400 into 30%, that is added. Then dividends are reduced. Okay, because here 100 into 30%, that is 30 million, we get 1090. Then for 20x7, the previous year closing balance becomes the opening balance. Again we add the earnings, which is 600 into 30% minus 150 into 30%, 45, we get the closing balance. So this is how the equity method solution is arrived. Okay, so and there could be situations where an associate companies, their book value is let's say is like 1000 crores. Okay, so let's say a company's as book value is 1000 crores, but the other company has acquired stake in that company above its book value. So 1000 crores into 20% is 200 crores. But if the other company paid more than that, like if it paid 300 crores to acquire the 20% stake, then it kind of paid higher than the book value. In those cases, that higher amount is it's not it doesn't come out of thin air. It comes because there has been certain revaluation of assets, not in the actual books, but for valuation purpose, the company is acquiring, they might revalue the assets. So let's say they have they increase the value of pp&d. Okay, they might think that okay, pp&d is valuable 100 crores more valuable than what it is in the book. In those situations, what will happen is they will have a fair value. So in this particular example, red company purchased a 30% stake in blue for $80,000. Okay, so which means what is the fair value that they are assuming? 30% means 80,000 for 30% means 80,000 divided by 0.3. So they are assuming 2,66,667 as the fair value for uh, blue company. Okay, so here you can see the book value is around 200 of for the net assets, and the fair value is 2,50,000. Okay, so in these situations, what they did is while they attributed the same value for current assets, 2,25,000, 2,25,000, in PP&D especially, they have revalued the asset by 50,000. Okay, while this 50,000 is it's actually this 25,000 is not being revaluated in the associate books, but it is only for the investment purpose. This value is assigned in the acquiry books. Like the parent company thinks that the asset is like value of 75,000, but actually in the books of associate it remains as 25. It won't change. So this overall won't change in the blues book, but in red company it reads these assets at a revalued figure. Okay, in these situations, so and the company follows like 10-year depreciation method of straight line method for 10 years of depreciation. In that case, what will happen is, so if Blue has reported a net income of 1 lakh, this 1 lakh is based on like the depreciation that is calculated on 25,000. But when the parent company acquired these assets at a fair value of 75,000, we have to account for the additional amount. Like for the 50,000, we have to account for this depreciation in the parent's books, the company which has invested. So what will happen is, like the 1 lakh, we need to reduce it by the additional depreciation that is need to be done for the PPND. Okay, let's go into the calculation how it is done. First, we are going to calculate the goodwill. Okay, so what is the purchase price? 80,000. And what is the book value? 30% of the book value. So it is 30% of book value, 2 lakhs into 30%, we got 6 lakhs, 60,000. Okay, we got 60,000 here. Plus, there is another 50,000 that is being revaluated. 50,000 to 30%, it's 15,000. So if we find out the difference, so they have paid excess of 5,000 for this company on top of its fair value. Okay, so this 5,000 is attributed to the goodwill, while the rest of the thing is attributed to various identifiable assets, current assets, PP&D, etc. So we recognize 5,000 as goodwill in the books. Then for the, especially for the equity income, what we do is we take the proportionate net income, like the 1 lakh into 30%, whatever the 30,000 is there. Then what we will do is, for whatever the depreciation that is being recognized, so here for 50,000 that is being revalued, we need to calculate the depreciation for this 50,000. Okay, so 50,000 divided by 10 years of straight line method. So how much it will be? 50,000 divided by 10, it is 5,000. 5,000 into 30% stake is acquired, so 1,500. So we are going to reduce the equity income by 1,500. So every year this is what happens. So whenever, so for example, next year, if that this 30,000, the income increases and it becomes 32,000, again we are going to take 32,000 minus the 1,500, which comes to 28,500. So so this is the thing, like this is a special adjustment when will be done when the acquisition amount, like whatever the price it is being acquired for, is higher than the book value of the associate company. So in the balance sheet, yeah, like we take the purchase price we use, then we add the equity income, then we reduce it with the dividend received and year-end investment we get in the balance sheet. Any questions so far?
Sir, one effect will be of this extra paid 50,000 extra paid. One will be in your equity,
Hmm.
and the second effect will be it will increase my equity in the holding company
Hmm.
balance sheet. And the second effect on the asset side will be uh, it would reduce the depreciation or increase the depreciation.
Yeah. So yeah, so like this is the this is the fair value for which the acquiring company is acquiring. So in our books, what will happen is, in the asset side, we will show 80,000 when we acquired here. 80,000 we will show in the asset side, investment associate. Cash will go away. It will balance out. That is fine. Then next year, what will in year one, what will happen is 80,000, 80,000 the initial investment. Forget about this. So here, yeah, 80,000 plus the equity income will be 28,500. Even though it is 30,000, we have provided a 1,500 additional depreciation on the revalued asset. Okay, so this additional 1,500 depreciation is provided. That's why 30,000 is reduced to 28,500 minus the dividend received. We get 90,500. Okay, so like what will happen is in the so this is it was already balanced when the initial recognition was made. Then after equity income will this one will increase by 28,500 here, and in the equity also on the liability side we it will increase by 28,500. Okay, then it will reduce by 18,000 dividend the in on the asset side, which is being offset by cash received of
Okay.
dividend received. So
Okay.
that way, assets and liabilities, it's more of a presentation purpose.
Mm-hmm. Understood.
So as such, like the main concept behind this is they cannot assign everything to goodwill. So even the book value is 2 lakhs, if they acquired it like for 25 2 lakh 50,000, this 50,000 difference, if they don't revalue the asset, then the entire thing has to be allocated to goodwill. So that's why they have created a PP&D portion here. Like they have revalued the assets. Probably it might add higher value. So that 50,000 we are actually the acquiring company is creating. So that's why only acquiring company is going to add additional dividend in this case. So that's why it this 1500 won't come in the associate books. It won't be there. Only in the parent company books it will be there.
Okay, sir.
Any other doubt? Okay, let's do a few questions on this module quiz. Will be clear when we do that. Can anyone else read Garima or Muniasamy? Can you read the question?
If a company uses the equity method to account for an investment in another company, then option A is income is combined to the extent of ownership. Option B is all income of the affiliate is included except intercompany transfer. And option C is earnings of the affiliate are included but reduced by any dividends paid to the company.
Any guesses on the answer? Like, as so far what we have done. Like it's a bit tricky one, so just be careful. Like Jeremy or Muniswamy, do you have any thoughts on this? If a company uses the equity method to account for an investment in another company, so basically here what they're saying is the company is using equity method. So equity method, what we will do, we take the net income. We don't just add the entire net income to the parent company. What we do, we add only the share of net income that the parent company owns. That means the ownership. Okay, so first option is income is combined to the extent of ownership. That seems reasonable. Okay, let's wait. Second option, all incomes of the affiliate is included except intercompany tax. All income we won't include because the company is not 100% owned by the parent company. It's only partially owned, either 20 or 30%. So all income, that's straight away wrong. Income of affiliates are included but reduced by dividends paid. This is a bit tricky. We might get confused because in the balance sheet we actually do this. We take the purchase price, we add the earnings, we reduce the dividend share, then we arrive at the closing balance. So this a bit misleading to mislead us, but it's the option A that is the right answer. Okay, so let's go to the next one.
So in that one, why would we eliminate option C?
So eliminate C because if a company uses the equity method to account for investment in other associates, earnings of affiliates are included but reduced by any dividend paid to the company. So in the income statement, it's not accounted this way. In income statement, we only recognize the earnings, right? So in the balance sheet, we take the purchase price, add the earnings, and reduce the dividend.
Okay.
So if they say like if in the statement C, if it was like purchase price, we opening balance, we add the earnings of the affiliate, reduce it the dividend paid, then it would have been right. And also the another thing can be if they had said only the share of earnings of affiliate. Here they haven't mentioned the share also. The extent of ownership also they haven't mentioned. So that is also a kind of a wrong thing. So that's why income is combined to the extent of ownership. That seems right. So here the question is, suppose company P acquired 40% of share of company A for 1.5 million on January 1st, 2023. During the year, company A earned 5 lakhs and paid a dividend of 1 lakh 25k. I think it's better to do it in Excel so that you will have the numbers. Okay, so it is 40% stake is acquired. So purchase price is 1.5 million. So generally 1 million is equal to 10 lakhs. Okay, so generally 1 after 6 zeros if we put, then it is 1 million. So what we can do is we can convert this into lakhs for our understanding. So it is 15 lakhs there. Then during the year, company earned full year. Okay, full year earnings. So please note that this earnings is like 100%. So be mindful that the company P owns only 40% of company A. 5 lakhs is the current year earning. Dividend paid is 1 to 5, 1 lakh 25,000. So at the end of 2003, company P reported investment company A as. Okay. So at the beginning, they acquired the company. So opening balance is whatever the acquisition price. So this is the opening balance. That is okay. Then we are going to add something. What is that? Anyone say?
40% of 500,000.
Perfect. So we add the earnings. Earnings share. Only 40% share we have to add. So we add this into 40%. Then we are going to do another adjustment. Any guesses? Like till what we discussed. We are at the closing balance. Garima Muniswamy, any thoughts on that?
Reduced by the dividend.
Yes. So we need to reduce it by dividend. %40 share. Here also we need to take 40%. Okay, the closing balance. How much we got? 1 point. So if we convert this into millions, we got 1.65. This is the right answer. Okay. What did we do? We took since it's the first year of this investment, opening balance is the same as purchase price. So 1.5 million. Then we add the earnings for the year, whatever the parent company share, the investing company share. That is 5 lakhs into 20%, 40%. Then the dividend that they received, we need to reduce it. So 1,25,000 into 40%, 50,000. Then we got the closing balance. It's quite simple. Next, for 2023, company P reported investment income of that like we already have here. So this amount, whatever this 2 lakhs is there, this directly goes into the income statement. So this is pretty straightforward, like here. Please don't confuse that. In income statement, only this part goes. Okay, so only this part goes to the income statement. This one goes into the cash flow statement. And this part goes to the balance sheet. For 2023, company P received cash flow from investee of. Okay, so you guys tell me like what is the answer for this? How much cash did they receive from this investment? I mean actual cash, not the earnings and all. This can be non-cash. Like what's the actual cash they receive? 50K. Garima is saying 50K. That's the right answer because yeah, here like the dividend paid that is what goes into the cash. 50K. Yeah, we are 100% correct. Any questions so far? Hmm, fine, right? So now we are going to go into the second part of the investment in associates. So like how in the first part we have seen it's only mostly book value that is being into play, but sometimes there can be reclassification options as well. So a company might want to recognize the associate as a at a fair value. Okay, Garima has asked a question: why we subtract dividend? That's also our income. No, okay. So that's a very good question. So here in significant influence, if for example, if we accounted this investment, like whatever this 40% we acquired for 1.5 million, if we accounted this as a financial investment, then we would have accounted for the dividend as income. Because we have no significant influence, we can't like influence their earnings power. We don't take the share of their earnings. We take only the dividend income we receive. But in this case, since it's an associate, we take the earnings share. Like we take the earnings share of the associate into our books and reduce it by dividend. Yes, for sure. Like dividend is what the cash that we receive. But the way we account for it is we account it for as an equity. Like how for example a company is there, their equity statement is nothing but opening balance plus net income minus dividend, right? So similarly we take the earnings minus dividend to get to the closing balance. While you are right, we get the cash, the 50,000 dividend income, we get the cash, but ultimately this 50,000 comes from earnings only. So we should not, like, once we got the earnings, it's already there in our reserves. So we should not double count it. That's what the basic concept is. We already accounted for earnings, so we should not double count it by taking again into uh, into into this, because we already taken it in our earnings, right? So when we record it in an income statement, we recorded the whole 22 lakhs in our income statement. Yeah. So in the income statement, if we had only 50,000, then this whole calculation itself won't arise. So equity method impairment, yes, both in IFRS and US GAAP. Impairment concept, I think you guys should be like pretty familiar, because in level one we have impairment on every long lived assets. So like the PP&E impairment, every year we are going to check for impairment and see if we need to provide for it or not. So generally in IFRS and US GAAP, uh, it's like every year, I think on an yearly basis, they do impairment checks. On IFRS, it's like the cash generating unit is seen. So if the fair value is less than carrying value and it's not temporary, this is very important. This is a key difference in IFRS. In IFRS, it should be fair value less than carrying value and it's not temporary. So, like, how do they determine if it's not temporary? So, like the fair value, how do they determine? By using the share price. If the share price is has fallen due to some temporary like fluctuations or something, that's fine. I mean, they don't need to impair it. But it is because of some structural reason, like they lost some like major business, or I mean there could be something like they operate somewhere in the war zone, and suddenly that particular zone is completely wiped out, so they might structurally get challenged. So those are certain permanent cases. In those cases only, we need to provide impairment. Again, under US GAAP, it is generally deemed as permanent. There is no particular test as in IFRS where like they have to prove that it's not temporary. In US GAAP, it is assumed that it is permanent whenever the fair value is less than carrying value. That's the basic difference. So yeah, so like IFRS needs an objective evidence, like some kind of a loss event. So let's say if there is some shipping companies there, okay, they have 5 ships in their total assets, and 3 of their ships might like if for example they are destroyed by fire accident or something, there is a major loss event. So it's kind of a permanent event. In those cases, there needs to be an impairment. It's more of like loss because of some like small cargo or something. Then it's not a permanent event and no need to impair. So impact on future cash flow, reliable measurement, those needs to be assessed. Asset write down to fair value and impairment loss is recognized in the income statement. And generally, once impairment is fixed, it's not reversed either in US GAAP or IFRS. Whatever impairment is there, it remains. And every year, once the company starts to gain profits, then the book value will slowly increase. The reversal of the impairment is not there. Goodwill is not separately tested. It's like whatever the overall carrying value is calculated, and whatever impairment is there, that is being provided. Yeah, this is an important one, like the transaction with associates. So let's say 2 companies are there, company A, company B. So company A has 20% stake in company B. So there could be certain transactions between company A and company B. Okay. So company A sold some 10,000 rupees worth of goods to company B. And company has recorded profits in its books. Like let's say on the 10,000 worth of goods, it has made some 2,000 worth of profit. So when but company B still holds the goods, whatever goods that it received company A, it still holds the goods before the end of the year, before the reporting period. So in this case, what happens is even though company A has sold the goods have not gone to a third party. It has still remained between the associate and the investing company. So what is happening is there might be some chances that like there can be profit inflation at company A because they might sell 1 lakh worth of goods to company B since they have significant influence. But company B might still hold the asset and company A might book the profits. That will inflate the profits, right? Unless that goods go to a third party, it's not that like companies made money. It's more of transfer between like linked companies. So that's why this thing comes into play. Like upstream transaction means from associate to parent company. There can be a situation, reverse situation, where the associate company sold goods to parent company. The associate company recorded profits, and again these profits, the share of these profits is recorded in the parent company. So it is kind of a double counted. So still the goods are there with the parent company. So that is an upstream transaction. So either it can be resold or it can be used in the manufacturing. That doesn't matter, but it has to be either resold or used by the other party for its own manufacturing purpose. So that's the main thing here. So whether it's an upstream profit or a downstream profit, the transaction, the whatever the profits, particular profits relate to that need to be eliminated. Okay. So investor company can influence amount and timing. So because investor company has significant influence on the other company, what they can do is, let's say like if they have some bad intentions, they can say, okay, our quarter is ending, we want to boost our profit. What they can do, they can ask the investing company, since they have significant influence, to buy more goods from them and they can record profits if this provision was not there. So because of that, what currently what is being so what this rule says is, whenever there is an upstream or downstream transaction, the unsold items or unutilized item at the end of the year, the profit needs to be reversed, the proportionate rate. So let's go to an example. Investor owns 30% of investee. Okay, during their investee sold goods to investor and recognized a profit of 15,000. Okay. At the end of the year, 50% goods remained in the investor's inventory. So what happened? They have sold some goods. The investee company made profit of 15,000, but only 50% of the goods are sold to outside party or utilized. 50% are still with the investor company. So what is happening is around 7,500 of this profit into is still not realized, and out of that 7,500, 30% is owned by investor. So 7,500, so 1 lakh or 15,000 into 50% into 30%, 2,250 is the amount we need to adjust from the equity income. Okay, this we need to be very careful. I think this thing is generally tested in the exam. So whenever there is an upstream or downstream transaction, we need to ascertain the profit that is being attributed to the transaction between them, and the of profit share of profit relating the goods or services that are not utilized, that share as into the percentage owned by the investor needs to be eliminated. Okay, it's quite simple. So let's see another example. Again, investor owns 30% investee company. During the year, investor sold goods of 40,000 to investee for 50,000, which means the profit is 10,000. At the end of the year, 10% goods remains unsold, which means 10,000 still within the network, like within the group companies. So 10,000 into 10%, 1,000 into 30%, 300 needs to be reduced from the equity income. Okay. So the final thing is like there is a fair value option for equity related investments as well. So there is election to treat them at fair value. Under US GAAP, the option is available to everyone, while under IFRS, only the finance institutions have the options, like venture capitals, mutual funds, unit trusts. Those have the option to recognize associate investments on fair value basis. Till now, what we have discussed, the associates book value, we need to compute as opening plus earnings minus dividend. But in this case, we can actually recognize the fair value of it. Once the option is made, it's generally irrevocable, and generally unrealized gains and losses goes into the income statement. Yeah, so these are some of the analytical issues. So what happens is, uh, like in equity method, you directly take the proportionate share of income in your operating income, like below operating income or above. So net income, whether you consolidate the entire company, either like you add entire sales, cost of goods sold, okay, assets, liabilities, everything, or you just add one line item, the earnings, just the final earnings into the net income. What will happen is, you add only the earnings directly as share of associate income, it will increase net income, but the sales amount remains the same. But if you consolidate it, the sales increase, the net income also increase. So the margins are generally higher if you follow equity method. So an analyst has to determine whether the company has selected equity method in good faith or in bad faith. Like whether to boost their earning, like the margins, did they select this method, or did they select it like genuinely, like is there a like only influence, no control is there, only then this method is selected. So that we have to determine. If for example we think that okay, this needs to be consolidated rather than using an equity method, then we have to adjust for it accordingly. Okay, so balance sheet again, assets liabilities are not added to assets and liabilities of the associate company are not added to the parent company. Only the net amount, like the book value of the net assets, is added. That also like might underplay the leverage, like the debt part, how much debt is there. Those things might not be actually shown. So these things we have to keep in mind why the equity method is used. Is it really like a significant influence thing, or the company has control but still don't wants to consolidate it, so it is using equity method. So we need to assess that properly. Okay, let's do some questions on this, and the concepts will be further solidified. So company M acquired 20% of company N for 6 million. on January 1st, 2023, Company N's debt and equity securities are publicly traded as on an organized exchange. Okay, so it's a listed company, Company N. Company N reported the following for the year ended 2023. Net loss. So here keep in mind it's net loss, not net income. Dividend of 6 lakh, net loss of 4,50,000. If Company M can significantly influence Company N, what is the balance sheet carrying value of Company M's investment at the end of 2023? Yeah. Anyone wants to give it a try? So how do we calculate the book value that we need to recognize in the balance sheet? What is the formula for that?
So initial cost plus earnings less dividend.
Perfect. So here, what's the initial cost?
6 million.
Okay, let's write it down. So Garima has said it's P. Let's see. 6 million. Okay, then you're saying the formula second part is we add the earnings. Yes. So in so here actually, so we add earnings if there is a profit, but in this case there is loss, 4,50,000. So actually we need to reduce 4,50,000 into 20%. Minus actually because we had a loss here. Then we are going to reduce dividend. How much? It's 6 lakh to 20%. Closing balance. So 5,79,000. 5.79 million. So answer is D. Probably Garima, I think what might have happened is you would have added this one, like then it's giving like 5 lakhs. It's small technical error, that's it. So since it's a loss, we need to reduce it. Okay. The answer is A. So the next question, Company M can significantly influence Company N. What amount of income should Company M recognize from its investments for the year ended 2023? Any guesses here? Jeremy?
So 90,000 loss.
Darima, I think you're clear on that. Is it 90,000 or you disagree with that? Okay. So yeah, we'll just put it. Okay. So the next question is, can you read, Garima, the next question?
Selected operating results for Lowdown Incorporation in 2022 and 2023 are shown in the following table. So they have given sales and operating revenues of 2022 and 2023, different figures, investment income, total revenues, operating cost, and pre-tax operating income. Now the question says, Martha Patterson, an analyst with Calderon Associate, have been assigned the task of separating Lowdown's operating and investment results. She intends to do this by moving the effects of the returns on Lowdown's marketable securities portfolio and forecasting operating income for 2024. Patterson assumes that growth trend in operating income from 2022 to 2023 will continue in 2024. The appropriate forecast of Lowdown's operating income in 2024 based on Patterson's analysis is closest to, and the options are $5, $650, or $700.
Right. Yeah. So, so here what they're saying is, so in general, what happens in the industry is this investment income is usually included above EBIT. Like, so some companies include it in their operating income. The operating margin is kind of treated as a very benchmark ratio in the industry. So to compare it with peers or something. So since investments are generally not a non-operating activity, so it should not be included in the operating income. So what we do is we adjust it by removing this from the incomes. So what will happen? So if here in 2022 45 million of investment income is there, 2023 160 is there. but this is actually a non-operating income. So we have to move it below. So if we remove 45 from both total revenues and operating income, how much we will get? 45 if we remove from here, 1000. Here also we need to remove 45 because indirectly here also it is included. So it is becomes 500. So here also we need to remove 160. Okay, it will become 500. Then here also if we remove 160, it will become some 1240. Sorry, 1140 something. Okay, so in a sense, the pre-operating income is nothing but 500 and 500. Okay, then she is forecasting the operating growth trend in line with 22 to 23. 500 means zero growth. So if we want to forecast 2024 similar trend, 0%. So it will become 500. Okay, is it clear? Like I think Jeremy, is it clear?
Yes, sir.
Yeah. So basically, what we are doing is in the revenues and operating income, this non-operating like investment income is included. We remove from both. So even though like now it seems like there is some kind of growth, if we use this trend, then it's not correct. So we remove 445, 160 here, 500, 500, then it becomes 500. So that's the answer. Yeah. Next one, Jeremy, can you go through this?
Suppose company P acquires 80% of the common stock of company S on December 31st, 2022 by paying $120,000 cash to the shareholders of company S. The two firms' pre-acquisition balance sheets as of 31st December 2022 and pro forma income statements for the year ending December 31st, 2023 are as follows: current assets, other assets, total assets.
Yeah, man. I think so we basically have some balance sheet items and income statement items.
Yes.
Let's go to the question. Immediately after the acquisition, in its consolidated balance sheet, company P will report total assets of. Okay, so basically, company P acquired. This is basically a like acquisition thing that has jumped into this topic. I don't know why, but let's do it anyways. Company P acquired 80% of company S, which means it's more of a control situation. We have to combine the assets. Here, like immediately after the acquisition, in the consolidated balance sheet, company P will report total assets of. So in a normal situation, like if we add these two, like 1.2 million, 3 lakh 60, 3 lakh 60,000, 1 lakh 56,000, you'll directly find this number. If you put this, it's wrong. So we need to, like anytime we get an easy answer in CFA, we need to think twice before going through because it might be wrong. So here we need to adjust for the cash that is being paid. Okay. So what will happen? 1,20,000 cash is paid to shareholders of S. That means it won't be there in these two companies once the cash is paid. So we need to take from here for company P, this 7,20,000 will become 6 lakhs. So that's why 6 lakhs plus 2,40,000, 4,80,000 plus 1,20,000. So basically it's 1 point, like we need to add these two minus 1,20,000. How much we will get? 15 lakh 60,000 minus 1,20,000. It's 14 lakh 40,000. Right. This is the correct answer. Is it clear? Just put a thumbs up.
Yes.
Yeah. So,
So could you please repeat the
yeah.
example?
So,
This part.
yeah, I will repeat. So, here the question is saying immediately after the acquisition, if we consolidate both balance sheets, like if we add both balance sheets, what is the total assets reported? So, as such, we need if we add these two, that's the wrong approach. But let's say if we add these two, we get 15 lakh 60,000, and we will find that answer here. But that's wrong because here company P to acquire stake in company S, they have to pay 1,20,000 cash to the shareholders of company S. Not to the company S, but to the shareholders of company S. So it is going out. So this assets will reduce by 1,20,000. So this will become 6 lakhs only. 6 lakhs plus 40, 4,80,000 will get, this will become 10,80,000. When we add 10,80,000, 10,80,000 plus 3,60,000 will remain the same. It will become 14,40,000. So basically what we are doing is we are adding two assets but adjusting for the cash that is being paid to the shareholders of companies. That's the important adjustment. Yeah, for the year ended 31st December 2023, company P pro forma consolidated net income is okay. So this is like again, so here it only owns company P owns only 80% of company S. So what we usually do, we add 3 lakh plus 60,000 minus we introduce a minority interest. So probably if you guys came from CA background or something, you will, or BCom background, any commerce background, you would kind of get this idea. But we are going to go in detail about minority interest goodwill in the next topics. I think that is more detailed discussed later. But so here you need to understand, we add these two, but this is like the 100%. So 3 lakhs plus 60,000, 3,60,000, that will be the net income if P owns 100% of S. But in this case, only 80% is owned. So we reduce the 20% that is not owned by P, that is 12,000. So it will become 3,48,000. So that's the answer here. Is it clear? I think, Jeremy, probably you.
So why didn't we reduce 20% while calculating the assets in part A?
Can you come again? It was actually breaking.
Also, I've asked why didn't we reduce 20% in part A when we were calculating consolidated assets of that company?
Yeah. So that what we do is actually we add entire thing here in retained earnings. We actually create a negative. We actually add minority interest, something called minority interest here to balance everything. So here also what we are doing in income statement, we add revenues, we add expenses. At the end, we reduce the net income by 20%. So that's actually the difference between a consolidation approach and an equity method approach. In equity method, we only take the share of income that is attributed to us, 20% or 30%, whatever it is. In consolidated income, in consolidated method, like the acquisition method, we add 100%. Then we at the end we reduce the share we don't own. So in this case, since we own 80%, we add assets, we add other assets, we add current liabilities. Here, 4,20,000, 1,80,000. Here we reduce it by the share we don't own. So basically 100, what we do is 100 we add minus 20, 80 we get. It's the same method as such. So here also we add like 9 lakhs plus 3 lakhs, 6 lakhs plus 2,40,000. At the end, even though we add these two, then we introduce one line item here called minority interest minus 12,000 to get the final part. Yeah, cool. So yeah, on its pro forma balance sheet, company P should report a minority interest of. Yeah, that's what we were discussing. So minority interest is nothing but 9,60,000 plus 60. This was at the beginning of the period. Okay, let's do a calculation. So at beginning is nothing but 9,90,000 plus 60,000 Okay, into 20%. We got 30,000 minority interest at the beginning. So we should not rush here. Okay. So then again, we have to add the current year income. Like the minority interest that is not owned by us, we already adjusted for it, right? Here. Like the 12,000, whatever the 12,000 we take, we add current year minority share. So like 60,000 into 20%. Okay. Then we will reduce by dividend. Dividend paid to minorities. 10,000 into 20%. Okay. So then the closing balance will be 39,000. Actually, so it's important that see the if you see the equity method, the flow is somewhat similar to how the minority interest is calculated every year. Okay, so here they will try to mislead us by giving us this answer as well. Like if we don't take into account the dividends, it is like it comes to 42,000. Okay, 42,000 we immediately put the answer, but we need to take into account the dividends as well. Generally, whenever so minority interest account or the investment in associate accounts, these act like a equity account. So that's why we take the opening balance, we add the earnings less the dividend, and arrive at the closing balance. Okay, is it clear? I think we have come to the end of the session. Next session we will discuss like so we have pending is joint ventures. We have business consolidation, acquisition, how goodwill is calculated, partial goodwill, etc. So it will be quite interesting. Okay, thank you for joining. That's the end of the session. Uh, Hope you learned something. Cool. Bye bye.
Yeah. Thank you, sir.